Hi, and welcome to this morning's early global view. It is Tuesday, October 27th at 7:45 a.m. Coming to you a bit later than usual because we wanted to see this morning's U.S. durable goods orders, and we're glad we waited because it has confirmed that we have yet another in the series of weak durable goods that points towards manufacturing weakness in the U.S. And of course, that may affect the Fed into this Wednesday's FOMC meeting and beyond. So we have to ask, what has all this meant to the markets? Well, quite simply, as usual, S&P future December contract hourly on the left, 30-minute on the right. And what we have is a situation where someone thought it was enlightened after a kind of stagnant early week out of Monday and Tuesday into Wednesday to lean on the S&P 500 future into Wednesday afternoon and knock it back down into and slightly below the 2010 to 2015 support, but not below the false down break from Monday of the previous week, the negated down break the market had pushed back above going out toward last Thursday, back in the 2007.5 area. Mario Draghi being so aggressively accommodative in his discussion on Thursday morning, that's an hour before the U.S. equities open for just about a full hour, caused this not just to open higher, but open back above the down break at 2021.5, which is also back above a key old resistance at 2020, the trading high of the lead contract into the September 17th Fed meeting. It quickly also pushed above 2035 to 40 area and held it, and then that People's Bank of China action Friday morning took it from up toward 2058 to 60 on Friday to gapping above it, holding it on the pullback Friday, holding it again on the early pullback yesterday, and lo and behold, where is it this morning? It's off 4 points at 2058, having traded nominally below it. Now, this old channel line doesn't really count as trend support anymore so much because it was negated, it was broken on a down break and exceeded, but it's an interesting reference point just to where it comes in early today. And of course, to look really bad, the market would have to be back below last Thursday's 2053 close. On the upside, the extended resistance is 2075 to 80, and above that, you have the 2100 area. Now, what's most interesting about the action so far is that this very weak durable goods that we saw in the U.S. hasn't weighed on the market all that much, and we'll have to see after knee-jerk selling, which we tend to get after these weak numbers, whether the psychology in toward the Fed tomorrow ends up bidding up again on the back of the degree to which this should further mitigate against any Fed rate hike, certainly at Wednesday, October 28th meeting, but maybe even through the end of the year. And you'll note also that on the sideways churn the last couple days, the very important hourly MACD is back down right around the top of the upper runaway band. And therefore, if it starts to slide further, it might not mean it's going to turn very weak, but it will diffuse more of the upside momentum. And that pretty much does it for the short-term view of the S&P 500.